that 9 o'clock-ish is acceptable. Okay.
Yeah. Yes. I like the ish. Even sometimes, it's, we're talking about money. It's 10,000-ish.
Well, we have a quorum, and it is 9 a.m. So we will begin our meeting. Good morning. My name is John Von Paris, and I'm the chairman of the MDTA Finance Committee. I hereby call the meeting of the Finance Committee to order at 9 a.m. In accordance with the live streaming law, the meeting is being conducted via video conference and is being live streamed on the MDTA Finance Committee webpage. All members will have their video active during the entirety of the meeting. I ask that anyone who is presenting or answering a question to please turn your video and audio on when speaking. When you are done, please turn your video off and put your audio on mute. To minimize background noise during the call, I would ask that everyone on the line please mute your phones except when speaking. There are no members of the public, no elected officials, and no media who have pre-registered to comment at this morning's meeting. This time we will begin with agenda number one. Agenda number one, the seeking approval of January 11, 2022 open meeting minutes. Is there a motion?
So moved, Member Carroll.
Okay, thank you, Member Carroll. Is there a second?
Member Ardinger, I'll second.
Thank you, Member Ardinger. Any further discussion? Okay, all those in favor?
Aye.
Okay, it's unanimous. Thank you. The minutes are hereby approved. The next three items on the agenda are updates, not requiring any approval. So we will go into item number 2, and we will, Alan Garman and Clayton and David will be presenting. Welcome and good morning. Welcome, David Calvert from PFM. And we'll be presenting and discussing the investment committee report, quarterly update on the investment of MDTA's funds. So good morning.
Hi, good morning. I'll start it off and just wanted to highlight it that we tried to tighten up the presentation a bit this month and get a little more precise on the themes. So starting off on the cover page, we're reporting on the trailing 12-month performance, primarily focused on the most recent quarter that ended December 31st. And there are 3 key themes that will be highlighted in the presentation. I think firstly and most importantly, the portfolio conformed to the investment policy limitations. And I think that's the key point, and you'll see that more detailed in the compliance report. Also, we're adhering to the board approved strategy, and I think that's evidenced by the portfolio performance that you will see that's performing in line with the index. And with that, I will turn it over to Clayton for the next slide.
Thank you. So slide 2 talks specifically about treasury yields, the move in treasury yields, what we've seen over the past quarter, this past year, especially is an increase in rates, across the board. Slide 2 shows the 2, the 5, and the 10-year movements in rate going back a little bit further. But I actually wanted to bring David in, if he would speak briefly about the economy, market expectations, and the Fed. David, can I turn it over to you?
Sure. So over the course of the last 6 weeks, we've basically seen a very significant shift by the Federal Reserve. In the 3rd and 4th quarter, the Federal Reserve was indicating that they might only raise rates in 2022 by 1 time. And that was evidenced by their Federal Reserve dot plot that they released on a quarterly basis. And starting in late December and definitely heading into January, the themes have been more focused on inflation. And I know I might be skipping one slide, but core inflation is hitting all across the headlines in terms of we're seeing costs of goods and services increase. It's not just isolated to the more volatile food and energy sectors. We're actually seeing underlying services and other goods actually increase in price. So core PCE as of December of 2021 was 4.9% annualized, and that's significantly above where the Federal Reserve wants to be. So what this has resulted in is the Federal Reserve is now focused on inflation, and the markets just can't keep up with their changing themes. Right now, the markets are expecting the first increase to occur in March, and there's a big question out there on how many increases there's going to be in 2022. The markets are saying that it could be anywhere between 3 and 7 this year. Clayton, I'll
And
turn it back
David,
to you.
the Fed's also been talking, David, about quantitative tightening. Can you speak to that a little bit as well?
Sure. So as part of the extraordinary monetary policy measures that the Federal Reserve implemented back in March of 2020 because of the COVID pandemic, they started buying up U.S. Treasury and federal agency debt at a pace of $120 billion per month. So they're continuing to actually add to their balance sheet, and their balance sheet is now in excess of $8 trillion. And based upon recent comments, they started slowing the pace of purchases. So they're continuing to add, despite the fact that we're well into the second year of the pandemic. But instead of having 120 billion purchased every single month, they slow that pace down. And it was originally going to be slowing down at a pace of $15 billion per month. So 120, 105, 90. But in December, they accelerated to double the speed. So they were accelerating it to a decrease of $30 billion. So by March of this year, so within 3 weeks, the Federal Reserve is going to stop purchasing new treasuries and federal agencies and adding to their balance sheet. This still keeps a very sizable balance sheet on their books. And they're saying after the first increase, they're going to start maybe allowing maturities from their treasury and agency portfolio to roll off. So instead of it being reinvested and maintained at $8 trillion, they're going to allow it to have some of it roll off. And all this means is that there's going to be more supply into the market. So with the quantitative easing policy, there was basically an indiscriminate buyer in the markets that was saying, we're going to gobble up $120 billion of assets. We don't care if they're not yielding anything. We're just buying it in order to help support the economy. So this has also helped pressure yields higher. And it's all in a measured fashion in terms of looking at the long term. But we are seeing a strong uptick in rates over the last 8 weeks or so.
Thank you, David. And that's important for the portfolio as we turn to slide 4, where we see the portfolio composition. As Alan noted, we've made a few changes to the slides, and we hope you find this a little bit easier to follow and to flow through. But on slide 4, we show the portfolio composition in the top right pie chart, and that speaks to the diversification of the portfolio and the opportunities that we see in the market as we go out and try to keep the portfolios fully invested and managed to the duration targets and the return expectations. And so to David's point again, we do expect to see maybe a little bit more opportunity in some of the places where the Fed has been playing, specifically the agencies, as perhaps, and this is somewhat speculative, but as perhaps maybe spreads blow out a little bit relative to treasuries in the agency market. But again, and Alan highlighted this with respect to the first slide, we are within compliance of the measures implemented by the board, and we follow those strictly and adhere to those. But we do see relative value opportunities occasionally and have the opportunity to invest in those, and that's reflected in this slide 4. At the bottom of slide 4, you'll see some of the activity in the portfolio during the course of the quarter. We have made some investments in treasuries, commercial paper, and a little bit in the agency market. Alan, do you have anything to add?
No, I just maybe perhaps one thing that the primary driver of that pie chart is either a cash flow needs, so you have higher compositions of cash and equivalents in the operating and capital funds. And also we have in the capital funds category our bond proceeds. So that drives the need for very short-term investments. Those are typically the Maryland Local Government Investment Pool, money market mutual funds, short agencies, and commercial paper. And the rest of the composition is really relative value opportunities. If we can pick up a little bit more yield in a treasury of the same maturity versus an agency, then we take those opportunities, and the same is true for municipals and supranationals. So that's really a function. And then we bump into policy limits. We're not near any of them currently, but at times we might bump into the 20% policy limit for taxable municipal bonds or supranationals, but we're well away from those now just because spreads have been relatively tight and there hasn't been a lot of opportunity. We're seeing a little bit more recently in the municipal sector where municipals are getting a little bit cheaper relative to agencies. So we're seeing some opportunities to swap there.
Member Rosen, you have a question? So Member Rosen, we can't hear you.
Can you hear me now?
Yes,
Yeah.
we
All
can.
right.
Thank you.
Put up. So I have a question. It's really just more on the aggregate. So I appreciate that, Alan, in terms of where we're investing. But so we were at 898 million. We added 230. We took out, or we had to cause maturities 154. That's 974, and then we were at 866. So did the value decrease 107 million, or were there other outflows?
We haven't highlighted the money market changes. There's lots of purchases and sales of money market instruments. So you could see like the beginning market value of approximately 890 million. The portfolio only dropped about 30 million. The difference there really is money market purchases and sales as well in there. We're spending for the capital program, so that's why you see the decline. So each month we have net operating income, excess toll revenue come in that's then set aside for capital spending. So the fluctuation in the value, you should see a downward trend in the total assets until we have the next bond financing, probably in early 2023, calendar 2023.
So in this chart, would it be possible to add that going forward, where the monies that we're taking, whether it's for capital or operating, those outflows, so that we can see the pure change in market value?
I think
We can either, I know that there's so much activity with the money market mutual funds. We can either try, if we can, to add purchases and sales, because they're every day, or we will break that out separately so that you can see the treasuries on down some and then cross-foot over.
Yeah, however you need to do it. I'm not, you don't have to get too detailed, just at a high level, so we can see what the market value impact is versus pure, daily operations.
Yeah,
Okay.
I understand your point exactly, because if you only look at the total line, you would have expected December 31st to be higher.
Yeah,
Exactly.
and Member
Thank you.
Rosen, that's a good point, Member Rosen. I think what we're trying to distinguish here in this table is the difference between discretionary, if you will, and non-discretionary, i.e. the discretionary being investment decisions made by the team here internally, as opposed to cash decisions made by other factors, such as capital spending that Alan highlights. And so we're trying with this table to highlight the discretionary, where is the team seeing value this particular period? But certainly we can add and change that.
Okay.
Great.
Thank
Thank
you.
If I might move on to slides 5 and 6, respecting the compliance. As you'll see at the top of 5, we've added a note stating that the portfolios are in compliance with legal and policy implications, limitations, and requirements. We've also left this statement at the bottom of slide 6, just to make sure that it's captured as part of the other part of the reporting, but wanted to highlight for your committee that there is compliance with legal and policy limitations. At the individual line item, at the sector and subsector levels as well. Perhaps that's enough on these, unless there are any questions. If not, then moving on to slide 7, I'll turn this over to Alan for a discussion of the strategy. Alan, you're on mute, I think.
Thank you. We have two broad strategies. One is a total return approach that's utilized for certain long-term reserves. That's at this point is just limited to our general account and the M&O reserve that makes up our unrestricted cash position that's maintained at $350 million per board policy, and that helps to maintain our credit ratings. The other strategy is a matched funding approach, and that's for our either seed or with the expected outflows. The two broad total return strategies are in the general account and the M&O reserve. The general account is structured with staggered maturities from 3 months out to approximately 5 years, and we're overweight in the 3 to 5 year portion of those maturity bands, and that's to maintain the portfolio's duration and in line with the board approved index. So our index is essentially a index of 1 to 5 year agencies with a duration of approximately 2.7. Similarly, for the M&O reserve, we have staggered maturities from 1 to 15 years, and we're trying to replicate the returns of an index of 1 to 13 year treasury strips, and the duration is approximately 6.9. The board approved a strategy change for that M&O reserve, and that's been fully implemented. And I just wanted to highlight that the longer term goal was to eventually lengthen the general account as well. We're in the midst of a tightening cycle with the Fed, so that's certainly not something we're prepared to recommend today or very near term. But once rates sort of normalize, there's a possibility in the next year or so that we might be coming back, when rates have risen, to eventually recommend that lengthening of that portfolio as well. I'll turn it back to you, Clayton, for slide 8.
Certainly, thank you. So actually slides 8 and 9 show the maturity distribution. As we mentioned earlier, we've made a few minor changes to the slides, and this is an attempt to clarify and make it a little cleaner. You'll notice on slide 8 that there is a significant weight or exposure to the front end or the shorter maturities. This is a factor of the monies that are held for capital spending by the agency, and so it skews every exposure to that shorter maturity. This is cash, money market mutual funds, MLGIP, and actually cash held at the various institutions where we custody the monies. Slide 9 highlights the longer term strategies allocation. Again, the general account and the M&O account portfolios. As Alan mentioned, the general account staggers maturities from the front end out to 5 years. And we're typically overweight the 3 to 5 year buckets. As you'll see, it's more along the 2 to 4 year buckets where we're typically overweight. The M&O, you'll notice the change out to the 15-year maturities there at the bottom in the legend, where we do take positions all the way out to 15 years and roll those on an ongoing basis. hopefully you find these charts a little bit easier to read. And we did eliminate the other bars because there typically aren't a lot of changes. They're typically modest, and so this is probably or hopefully more helpful. Slide 10, I will turn over to Alan if he will cover slides 10, 11, and 12.
These three slides are linked in theme. We're trying to show the relationship between yields, return, and discuss volatility and the rationale between shorter and longer term strategies. On slide 10, we've graphed the prevailing yields over a multi-year period for the two benchmark indices that we use. And the highlights here are just that longer term structured portfolios have higher yields generally than a shorter term structure. And that's really a function of the slope of the yield curve. So you take on more price volatility in the portfolio, and in exchange for that, you expect, higher average annual returns. And if you flip to the next slide, which is slide 10, we've got a bit more going on in this portfolio, but if you look at the bars, which are blue and green, your total return performance is a function of the coupon income, which is essentially your accruals, and the price return. So if you look in the far left bar, you can see back in 2000, the blue portion is your income return. That's the coupon income in the index. And then the green portion is the price return. So if you look from that down to the orange line, which is the yield, you can see that during that time period, yields were falling, meaning interest rates were falling. And that's why you get this big price movement or positive price movement. And so you can see that trend continue is that as rates rise, the green portion or the price return turns negative. And you see that in 2003 through 2005. So I guess the point here is that, we're typically buying at prevailing yields, and we can't control the movement of rates or anticipate, with any high degree of confidence when they're going up or down. So our price return or total return tends to be a bit volatile year to year. But in the next slide, you'll see that how that translates into multi-year returns, and that's in slide 12. Again, on slide 12, you'll see historical yields in blue, and this is just for the 1 to 5 year index. And then you look at the orange line, which is returns, and you can see that return line is much more volatile. So that's a function of those big price changes as interest rates change. The gray line is a bit smoother than that total return line for single years. The gray line is your rolling 5 year return. So one of the things that we've highlighted to the board is that our expected return for the general account over a 4 to 5 year period is likely linked with some degree of confidence to prevailing interest rates. And the last point on this slide really is to look at that red line, which is connecting the prevailing yield back in 2008, which you can see is close to 2%. And if you were structuring a portfolio on that day, you would be buying investments or a portfolio that had an average yield of around 2%. And so no matter what happened to rates, whether they rose or fell after that, you would expect that your average return over the next 4 to 5 years would be around 2%. And so that's what you see bear out with the gray line, is that the rolling 5 year return over a 5 year period converged back to approximately 2%. And so I think that's the thing that we can extrapolate for today, is that we've had 2 successive years of very high returns. You can see that in the orange bar or the orange line far to the right in 2019 and 2020. Even though prevailing yields were around 1%, we had very high returns because interest rates fell. And now we're at the point where interest rates are starting to rise. and the single year return is turning negative. But you can expect over the next 4 to 5 years that the portfolio is going to average back toward where prevailing yields are, which is around 1%. And with that, I will turn it back to Clayton.
Well, Alan, before we move on for a second, thank you. I thought these slides did an excellent job explaining the volatility that we're seeing today. And so the decision to increase our benchmark, to have a longer duration, the decision was when we looked at long term and the $350 million, it's a long game, right? We don't plan on touching that money, and so we're looking well into the horizon. The decision was to capture higher yield and accept the volatility, because if you have a long game, the averages will work out and we will be at a higher yield place. And so I thought these slides did an excellent job. If we only looked at what's happening right now and the values decreasing, there could be concern that, something's wrong. And I think these slides demonstrated that what's happening with the total return and negative performance is exactly what was always anticipated, because we accepted the volatility in order to have the higher yields long term. And so I thought that these slides did a really nice job explaining that and showing that volatility. And then you can see what cycle we're in now as Alan gets ready to present the next slides, or Clayton, sorry. Yeah. Thank you.
Hey, thank you, Deb. Are there any questions by your committee?
I just have one quick question. So are we holding most assets to maturity?
The structure of the general account is staggered maturities from 1 to 5 years, but it's necessary to sell some of the investments early to maintain an average maturity and an average duration in line with the benchmark, which is slightly over 2.5 years. So we can't hold everything to maturity. I think one key point, and there's this concept called rolling yield convergence, is that whether you have a laddered portfolio that holds everything to maturity, or whether you have a duration targeted portfolio, which is what we have, they effectively do the same thing in terms of total return and interest rate risk. So you might take comfort in thinking that everything's held to maturity, but the duration targeted portfolio has the same risk as a portfolio that's a pure ladder, where you're just holding everything to maturity and reinvesting. With the M&O reserve, the benchmark that we chose, we're able to create a bit more of a hold to maturity portfolio. So we'll have less turnover in that portfolio, with the caveat is that when we see relative value opportunities, we may, say swap from a 10-year agency into a 10-year taxable muni. We're maintaining the same average maturity in the portfolio. We're just taking that relative value opportunity to pick up yield.
Right. So we have to at times sell an investment that on paper will show a loss, but what you're replacing it with, when you look at the two together, we're getting more yield than we would had we been holding the original to maturity. And
sorry, Deb. If we refer back to slide 4, slide 4 shows that activity, purchase, sales, maturities, and we have no sales, and that's fairly representative of what's going on in these longer maturity portfolios, where we don't see a lot of sale activity. To Alan's point, we'll let paper roll off, and then as it rolls off, we'll go out and then reinvest it and ensure that the duration of the portfolios meets the targets of the index.
Thank you.
So moving on to slide 13, if we can then skip forward, we do see this impact of increasing interest rates over the past 12. Well, for the general portfolio, it's for all periods, for the 12, the 6, the 3, and the 1 month periods. In fact, the 5-year interest rate is up about 130 basis points over the past 12 months. And that increase in rates accounts for the changes and the returns in the portfolio and in the benchmark, where we see we've slightly outperformed the benchmark in the general account. Moving on to slide 14. Slide 14 is the monthly performance. But what this really highlights, I think, the big takeaway for me is the volatility of returns due to changes in interest rates. And I think that could be our emphasis here, is to show that rates are volatile. But again, as Deb and Alan have mentioned, we're in this for the long haul, and we expect the returns to do very.
Okay. Clayton, you're on mute.
I'm sorry. On slide 15, did I just mute accidentally there? Did you hear my comments on 14?
It was just a few seconds.
Got it. Thank you. So 14 again shows the volatility of interest rates. Again, as Deb and Alan have mentioned, we've accepted that. We're comfortable with that, and that has been approved by yourselves and the board. On slide 15, again, we have a table that shows performance. I think the takeaway here on this slide is the duration measure over to the right, on the right half of the table. The portfolio, the general account portfolio, is in compliance with respect to the duration targets, and that should be consistent through all times and a point of focus for this discussion. Absent any questions, if we move on to slide 16, that shows the M&O portfolio performance past 12, 6, 3, and 1 month periods. The M&O portfolio has been less volatile than the index. The light green bar on the 12-month period has a negative 227 return. The M&O account has actually been much less volatile, and this was primarily due to the transition as we transitioned from the shorter index to the longer maturity index that goes out to 15 years. As Alan had highlighted, we are now fully invested in that longer maturity portfolio, and so would expect to see going forward, to Deb's point, expect to see going forward more volatility in this portfolio than in the general account. And we're comfortable with that and have accepted that in light of the fact that we do expect higher returns. Slide 17, again, is busy, and we apologize for this, but this is meant to show the takeaway here, which is that the longer maturity portfolio in the orange, the yellow, is more volatile than is the portfolio and the other index, the shorter maturity portfolio, in the red. Slide 18 highlights the fact that, again, here in the duration segment on the right, we have fully completed the transition, and we are now neutral to the new benchmark. At the bottom right of that table, you'll notice that we are neutral to the new benchmark. I will pause here for any questions. Unless Alan has something to add, the other slides are supplementals. We have the investment considerations on 19. We showed the trade allocation by dealer on 20. And then again, the account level strategies on slides 21 and 22.
And so we, ask that you continue to support the current benchmarks, and that is what we would like to take to the full board for their approval. The continued support of the benchmarks that we transition to.
Okay, any comments? Alan, do you have anything else at this point?
No, I do not. Thank you.
Okay. There's some good in here, of course, obviously, and we all, everything, I guess the legal compliance and the policy compliance is very important. Member Rosen, you had a very good recommendation, and that will be, I guess, incorporated into the report going forward. Thank you for that. And Deb, I appreciate your willingness and the staff's willingness to always improve on the report, make it an easier read and easier to understand to all who are participating in this call and others who use that report and review that report. That's very important, and I like that because that's means you're willing to change, and otherwise we might have a report that's 10 years old without any changes, right? So anyway, I'm just kidding, but thank you for that. Thank you for that. And any other comments from any members? Okay. With that, then we will thank you all for joining us today and on this report, and we'll move on to the next agenda item. Item number 3, we're going to have Jeffrey Brown present the second quarter budget comparison, review of actual versus projected spending for the fiscal year 2022 operating budget. Good morning, Jeffrey. Welcome.
Good morning. For the record, my name is Jeffrey Brown. I'm the budget director for the MDTA, and I'm here to provide an update for the second quarter year-to-date spending versus the full year 2022 operating budget. As of December 31st of 2021, we have spent 31% of the budget compared to a target of 50%. Except for Object 13, which is fixed charges, all other objects were at or below the targeted spending level. The drivers, and you'll hear these kind of repeated, but there's 3 key drivers to this performance. The first is personnel vacancies, drives lower expense. The seasonality of certain expenses and the timing of invoices really drive a lot of this performance. Moving forward into a little bit more detail, for objects 1 and 2, salaries and wages, it is below budget at 42%. As mentioned, it's really the ongoing vacancies account for the majority of this performance. This is a vestige from the hiring freeze. We're still quite a few open positions that keep the costs lower. Object 3 is below budget at 15% spent. 2 key areas, telecommunications is at 25%. And again, that's driven by vacancies, less people, less devices, less costs associated with that. But the big driver is Object 305. It's at 0%, and this really is one line item is for the state radio system, which is 1.7 million, and that's billed once a year and has not been billed. So that's driving the lower expense for the object. Then all other objects or sub-objects within this is at a 40% spend, which is still below budget. Object 4 is below budget at 16% spend. This is kind of the ongoing COVID-19 effects. There's a lot more teleworking and telelearning, and there's postponement of in-person conferences, things of that nature keep the cost lower. Fuel and utilities, Object 6 is below at 33%. A big driver is electricity, which is below budget at 29%. We've been actively replacing lights with LED replacements in the tunnels and other areas, which drive lower costs. The timing of invoices have an impact here, and plus there's been the toll booth removals, which reduce our electricity needs. Motor vehicle and operations, Object 7 is at a 37% spend. As mentioned in others, timing of invoices and the orders of vehicle purchases drive this. A lot of the orders are already in place. It's just a matter of receiving them and things of that nature. So we do expect this to come back closer to budget. Contractual services at Object 8 are below target at a 13% spend. The key areas in this are advertising, which is at 10%. Again, this is seasonality. A lot of the programs occur later in the year. Plus, there was a coding area that should have been charged to this worth $348,000, and that would have increased the spend, obviously. Engineers were at 20%. Again, the timing of the work and when the invoices come in accounts for the underspend at this point. Equipment repairs and maintenance is above budget at 62% spent. And this is primarily due to the timing of some IT storage invoices. They've already hit the expense, and going forward, we expect this to come back close to budget. Building repairs and maintenance, 812 is below budget at 23%. It's a combination of seasonality. We typically have higher expenses towards the latter part of the year. Plus, there was some reduced cost for sludge removal in the Baltimore Harbor Tunnel. In the past, sludge removal was done using contractors. We moved to in-house and actually have done that with less expense. Janitorial services is below at a 34% spend. The construction shutting down some of the buildings for a period of time limited the ability for some of these people to get into the facilities, and that's kept our costs lower. The next three line items, education, management, and security, are all below budget. And again, they're all really primarily due to seasonality and the invoices, the timing of the invoices. So we'll have a better feel on this as we move through the rest of the year. But at this point, they are below budget. Fiscal services, Easy Pass retail fees, 829 is below budget with a 23% spend. Really, the timing of payments accounts for this performance. We do have some large payments expected to hit in January, and we expect this to come back closer to budget. The primarily IT objects, 841 through 869, are collectively 30% below or spend to budget. Really, the timing again of these invoices account for this performance. We do expect this to track back to budget. Service center costs, 870, or Easy Pass service center costs, 873, is at a negative 8% spend. This is a miscoding of some of the vendor payments, drives this performance. With the correction, we expect this to be closer back to budget performance. And then other contractual services at 30%. Again, timing of invoices really drive that. Supplies and materials, object 9 is at a 30%. Both roadway maintenance materials, 905 and salt 906, is below mainly due to the seasonality and the timing of these expenses. As you imagine, we're now hitting really the heavier part of the year for maintenance and for salt as we're in the snow season. So at this point, we are below budget, but we don't know where that will end up. It really will be more determined upon the weather and what happens in the next quarter. Ammunition is at 139%. We had an annual payment for the TASER contract, which hits in the first quarter. Plus, there was an additional purchase from the asset forfeiture account that drives this increase in expense. Uniforms is at 37%. Vacancies help drive this a lot. Plus, there's been supply chain issues. You've ordered well in advance and still have yet to receive a lot of the orders. And basically, the timing of the orders really account for this underspend. And Easy Pass transponders, 951 is at 23%. We expect this to be closer to the budget as there has been a greater need for transponders, and we expect to start seeing that through the rest of the year. Replacement equipment is at a 36% spend. The Nice Middleton Bridge new administration building has been delayed. So we expect the funds that were needed for this will be rolled over into next year. So we expect this to actually potentially track below budget. Additional equipment is at a 7% spend. Again, timing of equipment orders. These we do have a bunch of orders in place, so we do expect this to come back to budget. And as mentioned, the Object 13 is above budget at a 90% spend, and it's primarily due to an insurance invoice that hits once a year, but it did come in above budget at 112%. The remaining objects, at least at this point, are expected to be on budget. So that pretty much concludes my overview. So I'd be happy to take any questions at this time.
Any questions? Member Ardinger?
Yes, first of all, thank you for all that information, and definitely understand timing differences, and we're still at the beginning of the year. I guess what I'm really interested in is, do we have a handle at this point at all in regards to expenses that we think are going to be over or under, and not taking into consideration any timing differences? And For example, I'm specifically looking at a couple of items. One is the personnel vacancies. Is that going to have an impact in any way on the projected expenses? I'm also looking at that state radio system because I feel like every single time we get hit with a bill that's a little bit higher than what we expected. And then I also saw two items that I just to get some understanding on was the accrued leave payment. And it looked like also one of the engineering costs was higher than expected. So if you could just give us an idea of what we can see, what we could expect, not taking it, putting the timing differences off to the side and understanding that.
Yeah, Jeff, if I could address the personnel item
Sure.
and you address all the other items. So from a personnel, we expect to be under budget. However, we also had some civilian COLA increases that became effective in January that was not reflective of the budget. So part of that underspending in personnel, we expect that savings to fund those expenses. We're in the process. We wanted to complete our second quarter update with all the divisions, and we will finalize estimates involving personnel as well as the cost for those COLAs, and during the next quarter be able to be more specific about where we expect personnel to end the year. But if we put aside for a second the COLAs, we would absolutely be under budget. Rough guess, $15 million, right? Because it's not going to be twice as the amount that we were under during the first half of the year, because we have been filling vacancies. So it'll be high, the savings will be less, but there'll still be savings. We just need to offset that against the COLA expense to be able to tell you where we're going to end the year. So Jeff, if you would provide an update on the other items that Member Oringer asked for, please.
Hey, Deb, just to
Sure. And you,
something here real quick. That's the civilian COLA, right?
Yes.
Is that what you're talking about for civilians? Okay.
That's right, because the collective bargaining for the law enforcement that you approved becomes effective July 1st.
Okay, thank you.
And any increases for law enforcement that was negotiated during the prior collective bargaining was already reflective in this budget. They had steps and COLAs as part of the prior negotiations, but that was included in the budget.
okay. Member Ardinger, you'll let me know if I don't answer your questions. I'm trying to remember if I capture it, but just kind of dovetailing into what Deb just said. To give you an idea, obviously behind the scenes, I'm putting together schedules that are tracking our expenses. As Deb mentioned, the big one is obviously the vacancies. So I'm trying to get a good handle of what I expect that number to be, netted against the number of what the civilian COLAs and all that stuff will be, as well as, object by object going through and saying, okay, where do we think that, forget the timing, as you said, do we think we're going to be under? Do we think we're going to be over? Yes, I do have that list and I do have a general idea, but it's kind of in process. I think we'll probably share that at some point, but at this point, yes, there is kind of a list being put together saying, here's where we think we can be below because of, various reasons. We're not going to incur this expense because we're not doing that this year, or this, we're going to incur more of this. So that is in process. I don't have, the detail to share at this point, but there is some of that we're tracking to say, here's where we think we're really going to be by the end of the year. And obviously we're doing that because we may need to put an amendment if it's going to be above, or no, we're not going to because we're going to be below because of all this stuff. But that's kind of an in process at this point. And then the other piece is, I think you mentioned engineering. I don't know the specific item that you were talking about. I know in general, they expect to be there now, item by item on the engineerings. I'd have to go back and look, but I do know that gets a little bit more complicated because I believe there's some allocations that have to be pulled out of there and moved around. And I don't know if that addresses your specific line, but I do know that's some of the stuff that we'd have to look at on an individual line basis as well. So that's kind of from a high level. I mean, and I'll kind of stop here to see if, I've answered enough or if you have some kind of follow up to it.
I guess, like, for example, I'm looking at the first page of the budget versus actual. And what always stands out to me is the percentage spent. So right away, when I see 548.86% spent, and this time, this is related to the accrued leave payment. Or a little bit further down, I saw the 234.02% spent. Maybe I'm looking at this in wrong. I mean, it looks like in those cases, we've already gone over budget.
Right. I mean, obviously, if you've already gone over budget, that's an issue. There is some timing to some of those things. They do come in lumpy, but if you're above budget, like I mentioned on the insurance expense, you're going to be above budget. So I would have to go back and look, at some of those specific lines as to, exactly why. And is that going to be an ongoing thing for ongoing years, or is this just a one-time thing? I'd have to look at those specifically. I don't have the answer right offhand at this point. I have to look a little bit more detail, but you're right. Obviously, there's lumpiness to this. You're going to see it, crack, kind of funny to budget, but when you're above budget, obviously you're above budget. Unless there's an incorrect entry, in which case that has to be reversed and moved somewhere else, which I don't know that right.
And with accrued leave payout, that's for retirees. So when Jeff, correct me if I'm wrong, that's the retirees payout for leave?
I believe so.
Yeah. And so when someone retires, there's a cap on how much leave can be paid out, but their annual leave that's been accrued, normally when you're talking about end of the year, you're talking about 600 hours of leave. And so when you have someone retired that has very large leave balances, particularly very senior, it generally happens there, you have a large payout for leave. But also that position ends up being vacant. And so if you have a vacancy with someone that has a higher salary than a vacancy with someone that has a lower salary, you're going to have more savings up in regular earnings. And so it offsets each other. But that's what the accrued leave is just a payout. And from a materiality perspective, when we look even at personnel expenses as a whole, and certainly in the entire budget, accrued leave payouts are always immaterial.
Thank you.
Remember, under one other account you didn't mention, but it is an account that we're certainly diving into very deeply, has to do under Object 8, and it's, I'll call it out, the specific number. Give me 1 second. I actually don't know it by heart. It's 0873. It's outside services. It's the outside tolling services. We will be having significant invoices to pay coming up, and just quantities, verifying quantities. When the budget was put together, there was an assumption on a particular cost involving mailings. The actual's a little different on a per unit basis. And then also how many transactions are bundled together. You have to make assumptions there when you're putting together the forecast, because the postage and payments to the vendors is based on a per envelope. So those types of things, we'll be verifying that account and looking at that very, very closely also, so that those other savings that Jeff mentioned that we expect to have on other line items, that's part of this next quarter's analysis, is determining if any of that savings is needed for other line items. And that's one line item we will pay very, very close attention to.
Member Onger, this is Chris Thompson. The item you were looking at in engineering 807 for on calls, Jeff is correct in that on a quarterly basis, we do an allocation. And when this report was run, the allocation had not been done yet. So what we do is we charge it to this one account. At the end of the quarter, we back it out and we allocate it across operating and capital projects. So at that time, that had not been run. Okay.
Thank you. That makes sense.
Okay. Any other questions? Okay. Very good discussion here. Is there anything else on this that would you like to share at this point? Jeff?
No, not my, I think we've covered most everything, I think.
Okay. Deb, we're good here? You have anything else? You're on mute, sorry.
Yep, I believe so, unless the members have any additional questions.
Okay. Thank you very much. And
Thank you.
we will move on to item number 4. And Jeannie Marriott is here to present second quarter budget comparisons, review of actual versus projected spending for the fiscal year 22 capital budget. Good morning, Jeannie.
Good morning. I'm Jeannie Merritt, the Capital Program Manager, and I'm here to update the Finance Committee on the status of actual fiscal year 22 spending against the fiscal year 22 capital budget that was set in the fiscal year 22 to 27 draft CTP. And this information will also be presented to the full MDTA board on February 24th. As of December 31st, 31.8% of the fiscal year 22 budget was spent as compared to the targeted spending level of 50%. The total budget for fiscal year 22 is $602.9 million. The actual spending through the second quarter was $191.5 million. 25 of the 95 projects budgeted in fiscal year 22 were within the acceptable spending limits of 25% to 75%, which is plus or minus 25% of the 50% target. Due to normal lags at invoicing, generally 2 months, a plus or minus 25% threshold was determined to be reasonable. Actual spending through the first quarter, that should say the second quarter, for 8 projects budgeted for more than $10 million each in fiscal year 22 was $135.5 million. The 8 projects are detailed in attachment A. If you'll turn to attachment A, the fiscal year 22 capital program spending for projects with fiscal year 22 budget over $10 million. You'll see that the average of the spending on those highest items is 33%. It ranges from 11 to 45%. And we highlight these because altogether they represent a very large portion of the yearly budget. As a matter of fact, the Nice Middleton Bridge alone is 38% of the fiscal year 22 budget. Do you have any questions?
Any questions from any of the members? Okay. No questions.
Okay, I just wanted to mention, and I may start including this in the report. In the past 5 years, fiscal year 17 to 21, the Q2 average ranged from 30 to 38%, with the average at 34%. So you see that we're at 32%, which sounds a lot lower than the 50% target, but it is on target with what we've been doing over the past 5 years. Thank you.
Thank you, Jeannie. Any other comments from any members?
John, you went to mute.
I'm sorry, I apologize. I have a dog here now somehow got into this room where I am. I apologize. We're trying to figure this all out where we're living. So new home. But I'm okay now. So are there any other questions or any other comments? If not, that brings us to the end of all the items on the agenda this morning for the Finance Committee. Is there a motion to adjourn?
So move.
Thank you, Member Rosen. Is there a second?
Second, Member Carroll.
Thank you, Member Carroll. All those in favor?
Aye.
Aye.
Opposed? It's unanimous. We are here by adjourned. Thank you all very much.
Everybody have a great day.
Have a good
You
one.
too.